So our beignets now are a core item across the country. And I'll share with you that it is, like when we went through and we were piloting the beignets, I knew that New Orleans resonated across the country. It's a popular city. But I didn't realize, like as we tested some outer state cities and some local stores and so forth with the beignet program, the further we got away from New Orleans, the more popular the beignet was. Our highest volume store for beignets is in Bowie, Maryland, and does about 3 times the volume of what a store in New Orleans would do in beignets. It is a unique selling position for our brand to be able to offer that I think that most of our competitors are not going to be able to offer.
Why did PJ's Coffee dramatically cut back on its menu items? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with David Mesa, the president of PJ's Coffee of New Orleans. PJ's has about 200 locations and it is growing at a healthy clip. And we wanted to talk with David about the company's rebranding. PJ's is leaning into its New Orleans heritage with that rebranding, including the menu. We'll let David provide the details, but here is one interesting nugget. The company dramatically pared down the number of food items on its menu from hundreds to 18. David talks about that and the benefits. We talk about a wide range of other issues in this fascinating conversation, including the state of the beverage sector, which is growing at a very rapid clip. We talk about how PJ's fits into that. We also talk about development and the barriers to growth PJ's is experiencing, including interest rates and competition from other companies. We're talking coffee and beignets on A Deeper Dive, so please check it out. Okay, I am here with David Mesa. David, welcome to the podcast.
Thank you. Glad to be here.
All right. Well, why don't you start off? Tell us a little bit about yourself, sir.
David Mesa. I guess I've born in Texas, but basically raised in New Orleans. My family moved to New Orleans when I was 2 years old, and so New Orleans is home. And basically grew up in my entire life in New Orleans, except for a short 8-year stint in the Marine Corps. It's where I called home, and been fortunate enough to find my career there. And after I got out of the service, I got into franchising and have been in franchising for the last 25 years, and have been proud to be the president of PJ's here since I'm on board with them in 2016.
Since 23, you've been there since 2016.
I've been with Ballard Brands, correct, since 2016.
Okay. All right. How are things going at PJ's right now?
It really is going good. It's an exciting time for us right now. As I had mentioned to you earlier, we're going through what we call more of a reaffirmation more than a rebranding. We're calling it Project NOLA, which is really kind of the culmination of a bunch of other smaller projects that we're kind of wrapping up together and really reemphasizing our brand and our unique sales position. Very exciting time for us. We're about midway through that transition with our franchisees. So we're looking to get that accomplished before the end of the year.
Could you just describe what the project is about and what it involves, what it entails?
Sure. And again, I know I kind of just scratched the surface for that, but it's a bunch of smaller projects that we kind of rolled up. Like one in particular is just kind of, obviously looking to address the rising costs of everything really, but, trying to address the cost of goods at the franchisee level. And one of the things that I'm almost embarrassed to say is we kind of went in and started analyzing some of the data here. With 200 locations, we roughly had around 400 unique menu items for food. And so if you can imagine the waste and the challenge that puts on our purchasing and supply chain to try to source these items for our franchisees, it was, difficult task. So one of the things we did was went in and just started to analyze what's selling, what's moving, what's not moving, and literally whittled that down to 18 items. And so have optimized those items for our franchisees. Again, it has improved our speed of service and is improving our speed of service, also in minimizing waste, and also allowing us to start to strategize a little bit more with our vendor partners to get the best price. Because now, again, economies of scale kick in when you've got less items, but we're still moving tons of volume and we're able to get best price. And the ultimate effect is to improve those cost of goods. So that's like one aspect of what we call menu, the menu optimization for Project NOLA. And then Others is just redesigning our menu boards and adding new beverages to our menu boards. One of the things that, our USP, we've always attached ourselves to New Orleans, but really our USP, was really about our coffee. It was really about, sourcing the top 1% of Arabica beans, roasting it to perfection, and really about the cup. But, again, that really isn't that unique, right? Everyone always is going to argue that their coffee is the best. And so we started to recognize that, when we launched our beignet program, how impactful that was. And especially as you got away from New Orleans, where people were really have enamored themselves and attached New Orleans as a city of great food, great hospitality. And we were able to capitalize on that. And so part of Project NOLA is also about taking and leveraging that and kind of modifying our USP to be more about being a little bit more different, more about the spirit of New Orleans, offering all the flavors and hospitality and kind of changing our marketing position a little bit with a little bit more of a New Orleans flair.
I want to go back to the menu stuff. So I'm not going to say, so you went from how many different menu items to 18?
Yeah. Don't quote me on this, but it was in the hundreds.
It was in the hundreds.
Yes. Yes.
So you cut multiple hundreds of menu items. How on earth did you operate with that many menu items? That had to be.
And what was happening was it was more that many. It wasn't that we carried all of those items in every store, but there was the standards within the store were off kilter, right? So one store might have had this particular breakfast sandwich, and another store might have had a different breakfast sandwich, and they were all relying on the same, purchasing and supply chain to source those individually for those respective stores. Some of it is, was about eliminating items, but a lot of it was about consolidating to one item, right? Finding the best breakfast sandwich and then sourcing that for the entire chain rather than 15 different breakfast sandwiches across the chain.
Right. Okay. So a little bit you didn't have a consistent menu from one location to the next.
Correct.
Right. Okay. And so somewhat you basically just standardized the menu across the different locations. But I could see why that would work, where you would get more, where you would improve speed of service and stuff like that.
No doubt. And then again, so yes, and some of it was about eliminating items that just, and does that churro really sell for a New Orleans inspired cafe, or do we want to stick with the beignets, right? So things like that, and what was probably most surprising to me, and because that was a pretty emotional, I'll say emotional decision-making process, even though it was data-driven. It was probably more emotional for us and for the franchisees than it was for the consumer. Most consumers, no franchisee wants to hear the consumer, where's that double chocolate chip chunk muffin that I used to get? And the franchisee has to say, well, no, we don't have that, but we have this double chocolate chip, right? And so we have to remind ourselves that, you were only selling 3 of those a month and you were throwing 3 of them away. So you weren't benefiting from that customer that wanted that. And so, it took a little bit of adjustment, but so far it has been received overwhelmingly well. Very, very happy with the results that we're receiving so far as we're implementing it. With the Project NOLA launch, some of it is about, adjusting our cup sizes. We went from a smaller cup size to a larger cup size. Like for our cold, it's 16, 24, and 32 ounces. We increased the cup size, and simultaneously, we also did do a price increase. And so that's always difficult for us when we're trying to, want to be sensitive to that. And at some point, the consumer's only going to take so much. But it was a real comfortable increase when we increased somewhere between 6 and 10% depending on the beverages, but on overall they received a 20% more product. So it was a little bit more acceptable and a little easier to communicate to the consumer why the prices were a little higher than they were previously. So, we addressed that. We also talked about our alternative milks, right? There's been this ongoing trend of charging for alternative milks and your oats and your folks that are lactose intolerant and all the plant-based milks. So we eliminated the pricing for that. So that's inclusive of have your drink with whichever alternative milks you want. And then lastly, it was really just about, enhancing that customer experience, making sure that they understood whether that was with the music that we were playing in the stores, the uniforms that the staff was wearing, having them go through hospitality training to ensure that they're maximizing the experience that the consumer is as they flow through the drive-through or in dining. But really, the star of the show was what we call our NOLA favorites. And so typically what was happening is we were taking, kind of New Orleans inspired beverages and using them as our LTOs throughout the year. And so now what we've done is we've taken all of our best LTOs and made them evergreen. And now we have them permanently on the menu board as NOLA favorites. And, beverages like Bananas Foster or King Cake or Southern Wedding Cake. Those types of beverages that are offered, hot, frozen, or iced have really taken off. And it's funny because we never realized a lot of customers would always wait for that LTO to come around. And so how much feedback we've gotten that now the evergreen were able to come in every day and get their favorite beverage.
So I'll be able to get the Bananas Foster all the time then?
All year round.
Because that seems like, so the thing is, like, it seems like, I mean, the other thing you mentioned is that you're leaning into the New Orleans-ness, your New Orleans heritage, which is pretty important. New Orleans is a phenomenal city with amazing food and a really distinct local cuisine. So, like, to me, it would seem like if your PJ's Coffee of New Orleans, that those New Orleans items, like your beignets, like your Bananas Foster, beverages, that seems like that should be sort of a core item. Yeah.
It is. So our beignets now are a core item across the country. And I'll share with you that it is, like when we went through and we were piloting the beignets, I knew that New Orleans resonated across the country. It's a popular city, but I didn't realize, like as we tested some outer state cities and some local stores and so forth with the beignet program, the further we got away from New Orleans, the more popular the beignet was. Like our highest volume store for beignets is in Bowie, Maryland. And does about 3 times the volume of what a store in New Orleans would do in beignets. It is just, it is a unique selling position for our brand to be able to offer that I think that most of our competitors are not going to be able to offer.
Right. Well, we went to, like, I spent like the last holidays last year in New Orleans with my family. We got beignets every day. And the thing is, like, it's oddly enough, it's like literally one of the first things that people will mention to you, go to Canal Street, eat a beignet, right? Those sorts of things, like,
No doubt.
Pick up some beads. It's just sort of, and like, if you don't live within easy driving distance of New Orleans, it's a delicious product. Beignets are phenomenal. Now I want a beignet.
Yeah. Well, hopefully you have a chance to try them, try the PJ's beignets if you haven't yet soon.
You're going to have to get closer to my market, I think. So now you did all of this, even though it looks like, last year you actually had a pretty solid year. Talk a little bit about how that went, because it looks like you had some really strong growth, both on the, you added a lot of locations. You had some better average unit volumes. Tell us a little bit about how last year.
Yeah, we have really been in a pretty good growth mode here. We've got really our biggest problem right now is getting the stores open. We've got a great pipeline of franchise. Right now, there's roughly around 87 projects that we have that are in active development. So not licenses that are waiting to be developed, but franchisees that are somewhere between permitting and trying to get their doors open that are going on across the country. And, again, it's with some of the challenges post-COVID and with permitting and interest rates and things like that, it has taken a little bit of a toll on us from that perspective. As someone that just wants to get this positive growth open, we're averaging about 25 stores a year that we're opening, which is a nice, healthy clip. Don't get me wrong, but we're anxious to get our franchisees open and continue our development. Yeah. So and having another great year this year, we'll probably end the year or roughly around the same, about 25 locations. New locations open.
So you mentioned, is it interest rates? What are the biggest growth challenges?
Part of it, I think it starts with the interest rates, right? Finding the right real estate, right, is really where it starts. And, we'll have franchisees that'll spend 9 months plus just in site selection, trying to find that right, and especially for our model where we're looking for a drive-through. As you can imagine, post-COVID, almost everybody wants a drive-through. The reality of it is there's only 2 spots in a shopping center where you're able to lease out. So they're very highly sought after. So the only way to really take advantage of those opportunities are to sign leases when the development isn't there. You're looking at dirt and you're waiting on the developer to deliver the space to you. Then high interest rates kick in, and then those developers start to kick the can down the road, waiting to see what's going to happen. So that 6-month space delivery turns into a 1.5-year space delivery. So here you are, already a year behind your development before you're even able to start your own, fit out of the location. So it just kind of continues to spiral downhill, and you end up with a 18-month, timeline for getting a store open. Pre-COVID, that was probably 6 to 8 months for us from signing to the store open. So it is a challenge, and we see it ticking every time there's an announcement of a lowered interest rate. It's almost like you almost can see the spike and how things start to improve a little bit. So I think that's kind of been probably our biggest challenge so far.
Yeah, I can imagine. So what kind of sites are you typically looking for?
We're looking for end caps, drive-throughs with end caps. Also, we're doing standalone, depending on the franchising in the market. And then, as we started expanding towards, up the coast in the Northeast, there's a lot of markets there, like Virginia and so forth, that it's very difficult to get a drive-through. So in those instances, we're looking at inline spaces, in high foot traffic area to land our PJs.
Is it pretty competitive for those sites? No?
No doubt. And again, hence why if there's a space that's built out and end caps available, chances are it's not the right space for us. That's why we end up signing for pre-development, having to be in the world of the developers for forecasting when those sites are going to get developed, and try to get in early on those deals.
Right. Yeah, that's kind of the challenge. Like if a site is available, it might not be a great one from the get-go. And that's always the thing. Like a lot of restaurant operators want to move into these second generation sites, which on the surface sounds great. And a lot of times it is, depending on the concept you are. But sometimes sites are available for a reason.
Exactly.
I mean, they're available because it didn't work. One of the most amazing stories I heard, it did I talked to the founder of a sandwich concept, Snarf's Sandwiches. And like they moved into a location that had been six different restaurants over the previous 7 years. It was completely insane. Like you're kind of on drugs if you think that thing is going to work, and apparently it did. So you must have done something right. But the fact is that a lot of times it really is the site, and it's not really it's nothing else. Like if you move into a second generation site, you better make sure that site works, because sometimes the real estate doesn't work.
No doubt. And also, we would typically when we assess our second generation sites, where we would anticipate, we have some software that it kind of did some predictions on what the AUVs would be, but we would turn those down about 30% and then see if the math works. And sometimes you get a really good deal on those sites, and it's still worth doing, right? So hey, even if we were doing 30% less than our AUV, the math works and it's still a profitable location. But more often than not, yeah, you need to be a little leery of those. But there's always a reason for a site for why it doesn't work. But usually, if it's hasn't worked, you can have a bad operator and a good site and it still do okay. But a good operator and a bad site is a lot harder.
Right. So now you're operating in an increasingly competitive environment. So beverages, if I just say the term beverages, probably at least 5 executives within earshot of me would peak their ears up right now. Everybody, and I mean everybody, is intent on selling more beverages. You've got really intense competition in the coffee market in particular, but just beverages in general. What are your thoughts and sense on that particular market, and how does PJ's fit in on it?
And it is unique because as you mentioned, it is just beverages now, right? Even for an organization like us or a brand like ours that really is essentially focused on coffee, we still have also expanded into the refreshers and the energy drinks and the and the dirty sodas and so forth. That is kind of the younger generation that's coming up. That really appeals to them, and it's another way for them to get their caffeine in a different format. And so, yeah, we just recently launched. I'll tell you a funny story because getting back to the kind of our leaning in further to New Orleans, we launched in 23. We launched a partnership with Red Bull to do an energy line, and so we had some great drinks, and it was a reach for us because we had historically been more centrally coffee and tea focused. So this was kind of our first outing into that world, and we launched it, and it did okay. And as we started to look through part of the NOLA and really start thinking about leaning into the spirit of New Orleans, this past year we developed 3 new drinks with the energy line, and one's called the Voodoo, one is called the Hurricane, and the other is a Swamp Attack. And they're very I'll call them Instagrammable type drinks, right? With the edible confetti in them, and alligator gummies and things like that. And just by kind of taking that slight twist with the same or similar beverage, sales quadrupled, and actually slightly more than quadrupled just through that marketing pitch. And again, I think that's something that our competitors really can't lean into as much as we could. I think it might look a little silly for other folks, but being able to lean into that New Orleans theme really has paid dividends for us.
Right. Yeah. And I mean, I think that the thing is, like, it's important. It's more important today to have a broader set of beverages, I think, than really pretty much at any point previously. Because the thing is, like, if you think of today's, especially younger consumers, they drink such a wider variety of beverages than we ever did. Like, I was growing up, it was just hot drip coffee, and that's all you got. And if you wanted something cold, you could get a small selection of sodas, and that's it. But now, like, within walking distance of a lot of different places, you could get boba teas, you can get dirty sodas, you get cold coffee that's super customizable. You get all sorts of things, and drip coffee is almost like an afterthought at this point. In fact, a lot of chains don't even sell it anymore.
And it is also really it's also about how it's being crafted. Now you have to craft a beverage. The consumers become much more sophisticated, so they want to see that drink, right? They want to take a picture of it and put it online before they start drinking that. And so colors and toppings and cold foams and sprinkles and so forth, all of that is important on how that beverage is created. It's as important as the product that goes in the cup.
Right. Yeah. People definitely want to see their beverages. There is no question about it. Can't hide behind something. So now where do you see PJ's going in the next 3 to 5 years?
I see us continuing down this path, but really trying to focus on the consumer experience. What I'm seeing right now is, again, post-COVID, the consumers kind of abandoned in-house dining. It was all about takeaway, drive-through, and third-party delivery. Literally to the point where we almost considered just abandoning the dining and just going through drive-through onlys. And thankfully we held on for that, and because I am starting to see the consumer return to in-house dining. They're coming in, making the experience of it, ordering their coffee and sitting in the dining room and interacting with others and so forth. That is, I see that coming back, but I also see it coming back a little bit differently because they want to be served their way. And so now, it's funny because sometimes I would sit and just go to one of our cafes and sit in the dining room just to observe it. So we have folks that are ordering ahead on their app for takeaway. We used to call it takeaway. Now we call it order ahead, because they would actually just because they didn't want to stand in the line and have to deal with the barista. They would order it on the app. They'd walk in, they'd grab it at the takeaway counter, and then go sit. And that's their experience. And I kind of liken it to the change back in the day when you used to have to pay for your gas in the store, right? And then this new technology came out where now you paid at the pump. And so now I'm pre-programmed to pay at the pump, right? So, and I know, and I'm embarrassed to say it, but if I go to a gas station and the credit card reader doesn't work, I will literally get in my car and drive to the next gas station rather than walking 20 feet in to go talk to the clerk to pay directly. And I'm just predispositioned that way. And you kind of see it similar to that way with the younger generation. It's how they want it. It's the way they want it. And so we've got to adjust to that and figure out how can we utilize technology to enhance the experience for them while still creating an experience for them in store.
Yeah. Yeah. I'll tell you, I do the same thing. If their credit card reader doesn't work and they're going to make me go inside to pay, no. I mean,
exactly.
I'm even worse. Actually, I'll pay for my gas. Even if I do go inside, I'll pay for my gas there. I'll pay for my, gas, and nothing drives me nuts but I mean, I see your point. That's fascinating. Like today, because I agree that I think that consumers are going back into restaurants. I think that is, people want to get served again, and restaurant companies that can give consumers a good value in some capacity are going to win, I think, over the next couple of years, because I think that the consumer is sort of rejecting this, like, take out everything sort of environment that we've had. And one of the things getting them to come back in is just something that makes them want to is something that gets them excited. And I think hospitality is one of those things.
And the experience is what's going to lure them in. Again, I think value kind of can lure them in, but I don't know if that super glues them as a consumer. The experience is really what's going to lure them in. And it's so convenient to just order a Grubhub or Uber Eats and have something brought to you. So if I'm going to take my time and invest it into going out, I'm going to want to go somewhere where I'm going to feel good about that exchange and interaction. So I think that is truly the key to, as the consumers start to go more and more out, as you say.
Super. David, this was fantastic. I really appreciate you joining me this week on the podcast.
You're very welcome. Enjoyed it.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You can find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. But by all means, subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.